All right. So, welcome everybody to Modern Financial Wellness. My guest today is a repeat guest, John Donlon from Gold Coast Mortgage in Beverly, Massachusetts, is back on the show. John, it's great to see you again. Thanks
Yep.
for joining me again today.
Jim, I'm honored to be here. Thanks for inviting me back.
Oh, my pleasure. So, the big question we're going to be discussing today is to rent or to own, right? That seems to be a more prevalent topic in the news. Is homeownership still affordable or is it out of reach for a lot of people? Um, the whole idea of the American dream, right? Homeownership used to be a big part and a cornerstone of this concept of the American dream. And it just feels like the sentiment is starting to shift. People are questioning whether or not homeownership is a good idea with rates to where they are, prices where they've continued to go to. So I was really eager to talk to you today about what you're seeing. What are home buyers dealing with? What their mindset is? What are you seeing in the marketplace as you're working with people trying to help them attain that goal of buying a home?
I think homeownership is scary. It's a overwhelming payment. It is relentless that it shows up every 30 days and it knocks on your door for 360 payments in a row. And if you get sick or lose your job or have relationship issues, it doesn't care. It still knocks. And you have 15 days to pay it, or you incur a late fee. And at day 31, if you don't pay it, they'll bring down the hammer and start like literally legal proceedings. And the word mortgage in it, the word mortgage is the word mort in it, which is a Latin subroot for death. Like it just follows you to death. I think it's
Oh, no
always,
way.
yeah, it's like it's there. It's an instrument that just like you virtually never get out from under it.
So
So
that's
it's,
a fun fact. I never really realized the etymology of the word mortgage, but it's tied to the word death.
yeah, it just it follows you. Most people have it until death, right? There's like, a few people get out from under a mortgage. But my point is it's a serious obligation and it's heavy and it's real. And not that rent isn't heavy and real, but uh, if you go up a generation or two and you talk to your parents or grandparents or uncles, when they bought their home, it was scary as well. And it was never easy. Even if they bought their home for 30,000, it was still a commitment with the same gravitas that we have now. And so a heavy payment, a payment that's takes half of your income right off the top, that's not new. It's been going on for generations. So
Mhm.
it seems scary. And when you apply a $1 million purchase price versus a $30,000 purchase price, it would be easy to say this is more expensive. We have it harder than our parents or grandparents had it. But that's not true because my father was earning $18,000. That was his highest pay year, right?
Right.
So and now a couple could take home combined 180,000,
Mhm.
right? Yeah.
Right.
So it's really scary and it's definitely a challenge, but I don't think that's the new part of it. I don't think to me, the new part is that we have a competition in the housing market that didn't exist when our parents or grandparents were buying their home, and that's a private equity influence. And so private equity has entered the housing market, and that's new in the last 10 years. And
Mhm.
we're competing with private equity, and you're wondering, how is that possible? Well, private equity owns the majority of the rental units in Massachusetts, in New Hampshire, or in the country.
Mhm.
So renting an apartment is no longer, there's no landlord, so to speak.
Mhm.
It's an entity, and the
Mhm.
entity has bought or built a large apartment complex for profit, and they're in the housing game. So rentals compete with home ownership, in because they both provide a housing solution. Um, and the reason it's driving all the prices up is because private equity maximizes their investment. and so their rent prices are very expensive, and because it's a housing choice, it seems like everything's kind of going up around it.
Mhm.
S
So I've heard this idea that private equity and big financial institutions like BlackRock in particular are heavily invested in not only multifamily, 100 plus unit apartment complexes, but they're also buying single family homes. Is that what you're seeing as well, referring to here? So there's outside capital not only owning the apartment buildings, but they're also investing in single family units which some might think that they weren't in that space.
Yeah, so I'm not seeing that as much as I'm hearing about that
Mhm.
particular, and so, the market I know best is New England and Massachusetts and New Hampshire and Maine, and in there, BlackRock and companies like that, there are several of them that buy single family homes. They're not really, buying up the single family homes in the areas I work in because the homes are so different. They're not homogenized and kind of track housing or
Mhm.
in kind of they're not necessarily turnkey for rentals because they're all so different, or they may be an antique or on a private
Right.
road or what have you. So the housing competition to me is um, the zoning that's allowing companies of that nature to put up 4 and 5-story apartment buildings in the towns that also have houses.
Mhm.
And it's drawing a fair amount of energy and attention to the town, um, and the rents are, machine driven. They're, so it's not a human that's setting the rent based on his response to, let's say, Craigslist advertisement. It's an algorithm that's comparing rental prices for other apartment communities, and then they're actually setting the market prices based on a collaboration. It is illegal in Massachusetts. Is There's a class action suit against these companies for kind of setting rent prices illegally, and that's in the courts right now. But it's an unfair advantage that a tenant comes up against in terms of uh, renting an apartment where even if like your lease is renewing, um, you could find a cheaper apartment elsewhere. Your current rental situation will increase your rent because they know psychologically it's really hard to move from one apartment
Right.
to the other, and that you'd
Mhm.
have to give notice, or you would have already having to give given notice, 30 or 60 days ago. So you accept the rent increase even though the rents are down, and so so the housing solution through rentals is, uh, a very sophisticated game that the tenant doesn't even know they're playing in that game.
Mhm. But they
Oh.
do know they feel the increase in rent. I'd imagine a lot of the renters who are considering buying are mentioning to you that one of the reasons why they wanna get into home ownership is they're continuing to see their rent go up, and it feels expensive, and it feels like they're writing a check with no return, right? It's just straight cost, straight, expense. Um, so are you seeing a lot of folks that are feeling squeezed by this game, whether it's, they're aware of it or not? How are they feeling about, the rental situation in the areas you're familiar with?
I I think the rental situation is a little less scary than homeownership, even if it's a first step. So it it represents, some ability to move around if you needed to. There's a choice and maybe you go to a cheaper apartment if you needed to. So there's usually an aha moment that comes between making the decision to continue as a tenant or graduating into ownership. And it's, believe it or not, it's typically not financial, which sounds crazy. And so logically, ownership sounds like it should be a match because you're building equity and you're contributing. Um, but psychologically, the apartment represents a little bit of freedom that they still have. And so there's a dozen reasons why financially owning would be better, but the lifestyle choice of having the ability um, to to kind of move around, it's somewhat appealing to some of the tenants, and and that's okay. If your personality your speaks to being able to have like an exit option, or you can retreat to
Freedom
a
and
different.
flexibility, right? And being
Great terms.
untethered to a location, right?
Yeah, and that suits certain people really well.
Mhm,
Um, but there's an example of a tenant that we were talking to that had a young child, and um, the the neighbor below would use the broom handle to bang on the ceiling of their unit when the baby would cry up above in the bedroom above. And so yeah, and so for that type of situation, and so it terrified the child to the point it had to get taken out of the bedroom each time it cried, and the parents really looked at it as an act of aggression, which it was, but it was terrorizing. And but for the tenant below who didn't have children, they were trying to make the noise stop, and they did.
mhm,
So for that type of situation, ownership is much more appealing, right?
mhm.
And,
So
and
that's the aha moment
that's
that
the
you
aha
described
moment.
for that couple. Like,
Yeah,
we don't need a landlord banging on our baby's
yeah, or a
nursery
tenant, right? Yeah,
floor, right?
yeah,
Or a
yeah,
tenant, right?
yeah.
Yeah,
And
yeah.
and then so S so if I look back through the decades and the graduation between tenancy to ownership, um, there's that aha moment, and sometimes it's financial, but usually it isn't. It's like the
Mhm,
financial is the benefit to it,
mhm,
but the aha moment is, fill in the blank. There's literally hundreds of reasons the tenant could say, "Hey, this isn't working anymore." Like,
right,
uh I can't just let my dogs out, right? Or we're not getting, fill in the blank.
right,
And that kind of propels the impetus to begin to look at it. And then the financial benefits are just like icing on the cake,
right,
right?
right,
Right.
right. So you kinda start off with this aha moment and this maybe intuition that it's time for a whole host of reasons. I think I lived that personally when my wife and I, when we had our first um, baby. We were living in Boston. It was a little two-bedroom condo, and it was fine, and it worked out. But there just came a time where we both looked at each other and said, "It's time for a yard." We were also looking for, community, location to schools, all the boxes that a lot of younger couples with young kids want to check. We just felt like we were ready to kind of take that on and kind of move on to the next chapter. And it really didn't have anything to do with comparing rent to mortgage, which we can get into kind of the financial
Sure.
aspects of that. But yeah, I think that's a really good point that for me, I lived that experience as well, that you just start to realize what the important things are to you. um, do you have any thoughts or advice for folks that are kind of wrestling with that aha moment? How do you know when the reasons are the right reasons, so to
Mhm.
speak? So having a tenant below you annoy your baby, that's a great reason. Um, but it might not be the only reason, right? I mean, it's still, having an untenable renting situation doesn't necessarily mean you have to buy a home, does it? And how do you kind of sort out what the right reasons are, the right aha moments, and not kind of a visceral reaction to your environment at the time, if that makes sense?
It does. Maybe we could narrow the decision tree instead of talking about the right reasons. Talk about the wrong reasons to buy a house, okay?
Please. Yeah, that'd be
Yeah,
great.
and so, having played out, many homeownership scenarios, um, I've seen the mistakes. So, if you make a mistake and you buy a house and you're not a good match for homeownership, um, it can it can derail you financially. It can limit your choices in terms of, uh, a job you wanna take, but you can't because you own a house.
Mhm.
It can affect potential relationships or in your involvement, or um, it can affect your family. It's so many things it can affect if you buy a house and you're not ready for it. So, so I've seen people wanna buy a house for only financial reasons, and
Mm.
that can be a mistake, and so
And
the
what
f
are they thinking in that regard for only financial reasons that
yeah,
the
they're
mortgage cheaper than the rent? What are they
yeah,
facing?
they're trying to pick up like maybe a tax deduction on the mortgage interest, which may or may not even still be available to them, but they've just heard about it, and so they think that the financial reasons are, um, kind of the reason they should be in home ownership, but they pursue those financial reasons only, and
Mhm.
then they get to the other side, and their company has relocated out of state, and it's their dream job, and so now they're stuck with a house that maybe they become accidental landlords by renting it out, or they have to sell it, and they have to sell it quickly so that there's an expense to selling a house, and they lose their down payment to pay a listing commission, right? So, the financial piece of it, I think is wonderful that you and I are both in finance, and we could speak to that all day and the benefits of it. Um, but it could be the wrong reason. It could be a mistake to just look at the financial part when you haven't had that aha moment or you're not ready to do it, buying prematurely. So I think it's a hybrid, right? It needs to be your aha and your why, uh,
Mhm.
is it coupled with the financial benefits of it, and, we could certainly show the benefits, um, and there are many, but if you're now isolated with your home in an area where your family can't come to visit you as often, or, you buy a house and you wind up with an environmental issue that's over the fence from you, which could be like a toxic neighbor, or there's something going on, behind you. It wa- f- we see a lot of things related to you move into an area that you're not, you can't live in that area because of some inherent conflict you have with the environment, like
Mhm,
usually
mhm.
people or personalities, right?
Right.
Right, and they're just not equipped to handle that kind of a situation.
Yeah, you can't choose your neighbors, right? When you're
You can't choose your neighbors, but you can research them ahead of time, right?
you're
And
right.
and so in a fast moving environment, people neglect to kind of vet their neighbors, and um, if you share a fence line with somebody, they're stakeholders in your real estate investment, because what they have going on, you can hear, you can smell, you can see,
Right.
you experience it. If there's a high emotion activity over the fence, you have to absorb some of that emotion, even if you don't want to.
Yeah, yeah. So it's a good caution, I guess, and I'm thinking about somebody having this aha moment where they have the right reasons, they know why they wanna buy a home, and they know what they're looking for. It does seem to start to speed up at that point where people start to feel like they need to get something done, and that's where you start to incorporate the financial and that scary nature of the financial commitment you're about to make. Do you see kind of a switch in gears where they've made this decision, they're ready to go, and now they're extremely eager to get something done, but faced with a pretty daunting task of the financial obligation that comes along with it?
Right. It's you wouldn't want homeownership to be a knee jerk reaction to an aha moment,
Mhm.
because then you're apt to rush into it and make mistakes, not build the right team, and I think the success of the homeownership journey is dependent upon the amount of time that you give it. And so, if you have a very short window to transition from tenancy to homeownership, um, you may get stuck with a property that isn't perfect for you.
And you, on our last conversation, you shared, you had broken that down to the amount of hours, I think, that go into a real estate transaction to do it well and
Yes.
give yourself enough time and make sure you're making the right decision. Do you recall what that number is? What if you had to put a number to it? Again, I think you shared it in our last conversation,
Yeah,
but,
it
like, how
it's
much time does it take?
I assure you it's more than dozens of hours. We're getting into you're getting into hundreds of hours,
Mhm,
the hundreds could be more, and that's a combination of course, exiting, but also on the buy side, there's emotional attachment to properties that you won't get to own. So, like,
mm,
you become emotionally attached to it, but you don't win the bid, and that
mhm,
ties up a fair amount of bandwidth, and
mhm,
that's all a necessary part of homeownership is the failure part of it. So to experience buying the right house, let's say a successful transaction, you do have to experience failure of an at bat and you miss.
mhm,
And I call that a necessary step to home ownership because you're figuring out what wasn't going to work for you.
right.
And when things fail, they fail for a reason.
Yeah, yeah, we
Right.
went over that. I'll link I should know the episode number, but in our prior conversation, I'll link to it where we explored kind of the emotional aspects of buying a home.
Mm.
And, I've had those failed bids that absolutely were for the better,
For
right?
the better. Right.
And I'd be the one that was rushed into it and regretting a big purchasing decision if we had ended up with some of the homes that we or had originally bid on, and we're glad that they didn't work out. So if people are interested in kind of the emotional aspect of real estate and buying a home and the mortgage process, they should check that episode out, and we'll link back to that. But overall, it's a big deal. Takes a lot of time. Takes a lot of attention. There's going to be some misses, and then there's this again going back to some scary numbers that you start to see when you calculate mortgage payments, down payments, just the obligation that you carry with you for a long, long time. What are you seeing now as people are reacting to where interest rates are, where home prices have remained? Are you seeing people trying to thread a needle and, get a deal, not being willing to pull the trigger because they think rates are going to go down? I've heard a lot of different things about where real estate is right now, and I was just kind of curious your thoughts or what you're seeing.
Yeah. Uh, so there's an inherent nature in us to try to get a good deal or avoid future buyer's remorse. Um, and when we're looking at it, we may think that the same house could be cheaper in the future, or the cost of money may be less right after we lock our interest rate. And
Mhm,
we don't know that's going to happen. And in fact, it probably won't, or it may not. But that is potential future buyer's remorse.
mhm,
And I have noticed that people are trying to avoid uh, making a decision because they think it could be the wrong one.
mhm,
But in my opinion, they're focusing on the wrong decision. It's not so much that could you buy this cheaper in the future because the rates are lower or the house comes down in value, but the real decision is, do I want to get on this train that's called home ownership, and
mhm,
where will it take me?
mhm,
Um, so the folks that are most apprehensive about the future price of real estate are the ones that aren't fully committed to the homeownership journey. And
interesting.
yeah, so they'll blame it that they think housing prices are going to come down, or they think interest rates are going to come down in the future.
Mhm,
But really, they're having trouble geographically separating from something that they've been attached to for so long, or they may realize that this represents a commitment to a relationship that they're not ready to commit to yet, right? So
interesting.
a couple's been living together for years, but now all of a sudden the home ownership is a blending of right. It's a pre-marriage commitment,
Right.
and they'll 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 cite it's too expensive, or I think prices are going to come down, or there's I heard the Fed's going to lower interest rates, and so they say that, but really there's something else underlying that we'll never know about. But
Right.
that's why they're slow walking it.
It's an
And
interesting point you bring up. So you think that when people are looking at interest rates and trying to make predictions about where they head in the future, or trying to assess the market and predicting that real estate prices are going to cool off or come down in the future, you think that's tied to somebody with some kind of underlying, whether it's conscious or subconscious, something else is going on where they haven't, either verbalized it or even explored, why they're feeling that way. There's something else happening there.
yeah, and
Yeah.
that's the easiest, kind of, stall tactic to put out there. Like the markets, I'm not, there's going to be a change, and it also makes me or them or anybody who's offering an opinion on the future of these things that we have no idea
Mhm.
about. It makes us seem like we're important or people are like interested in our opinion, and really it's a wild guess based on ego and a need for like approval.
This
And
is a
it,
good side note. I wanted to go here and just reiterate what you just said. If anybody is telling you where interest rates go from here or where the market will be in a couple of months in terms of home values, they're guessing, right? And we
they're so
rubber stamp
guessing,
that.
and
Yeah.
at your detriment too.
Right.
It's it all any guess or speculation is apt to hurt the buyer,
Mhm.
um, and it and so even if the buyer's doing it, they're hurting themselves.
Mhm.
And so let's talk about interest rates briefly. Um, Interest rates are in the news several times a day. Mortgage rates are in it's clickbait. Yahoo will typically post 2 to 3 articles a day about mortgage interest rates because they know everybody's so fascinated with it. And so they'll tie in the Federal Reserve, lowering their rate. We're in a 2-day meeting today, and there's a press announcement coming tomorrow. Has nothing to do with mortgage rates. They're setting the prime lending rate, they're setting the bank overnight rate, but the mortgage rates don't watch the Federal Reserve other than a very small byproduct of what could happen.
Mhm.
So, the mortgage rates are, derived from the yield on the 10-year Treasury product, a
I know.
traded product. It's sold at auction. It's supply and demand.
Mhm.
And then there's a spread that sits on top of, the yield. So it's the yield plus the spread, and there's your mortgage rate, almost
Mhm.
like to clockwork.
Mhm.
So let's say that the yield's at 4.5, and you've got this approximate 2.5% spread. Your mortgage rates are 7, and
Mhm.
that follows pretty closely. Sometimes the spread may vary. So when somebody's asking me as a mortgage professional to predict mortgage rates, it's a very casual question. Where do you see rates going? How are rates going to be in the future? What do you think of rates? The rates,
Mhm.
are they going to come down? They're really asking me to predict the yield on the 10-year treasury. That's really what they're asking. They don't know they're asking that.
Mhm.
Now, for me to try to predict the yield on the 10-year treasury would be negligent, right?
Mhm.
Because there are bond traders out there that make $1 million a year,
Mm.
and they get it wrong probably like 45% of the time.
Mhm. Right.
So, right,
Yeah.
they may be right 55% of the time, and they're paid 7 figures, so they get it wrong. And so me as with a minor in economics from a state school, how am I supposed to like, make a prediction that
Right.
you're gonna rely on for the safety and security of your family where you're gonna live,
Right.
right? Basically, I'm
Right.
telling you in not so many words, if I think rates are gonna come down, I'm saying don't get on the train, right?
Right.
Don't buy, right? Because rates are coming down. And
Yeah,
then
don't believe or trust in your aha moment. Delay that aha moment and leading to that path to homeownership. You'd be saying, don't trust that, right?
right,
And delay
right.
that and don't make that commitment and that decision. Yeah.
Yeah. It's
Yeah.
scary. It's
Yeah.
scary because the train's leaving, they're not
Mhm.
on it, and then they may have to run to catch that train in 2 years, and they simply can't. It's like
Uh-huh.
it's gone. Like, it's
Uh-huh.
now, pre-COVID versus post-COVID, like, the prices, are up, 50%, let's say. Like, they're
Uh-huh.
like, "I wish you hadn't said, 'Don't get on that train,' because if I had gotten on that train, my family would be better off. I'd have a higher net worth. I'd have equity, I'd be involved in a community, and yet, because I implied that interest rates may be coming down, or I knew they're coming down, they never got on the train. They
Right.
stayed as a tenant, and they let a private equity company wring the heck out of their budget. Right? It just continued to increase the rents.
The other interesting aspect of the rate conversation, when you amortize a 1/4%, a 0.5% decrease, and what that means for your payment, your month to month payment over 30 years, it doesn't make a whole heck of a lot of difference when it comes down to it.
Yeah,
You're talking a few $100 a month, maybe low thousands a year, which I'm not trying to discredit, a few $1,000s
right.
as being meaningless, but if you've had that aha moment and you're trying to find a path to homeownership and you've found the home and the community and all the things that you said were important to you, then, rate to me almost doesn't matter if it's affordable, right? Which is kind of the segue into maybe another part of the conversation is affordability, right?
Yeah,
Versus just strictly thinking about the rate.
yeah, yep, and so in the same vein, sometimes if we're bidding, we know there's a number that we can end the conversation and win the bid. And so I'll talk with clients and we're like, okay, for 10,000 over, maybe where we're already over, for an extra $45 a month, we can get on the train
Mhm,
and take the extra 10,000 and, you know, in the price increase in the mortgage debt, you're probably going to take 8,000 of the 10,000. And that's one, cup of coffee per drive through per week that you just have to cut out of your budget,
mhm,
and you've got it. And that's what it comes down to.
right.
So, yeah, the the affordability piece of it is, uh, I let's say a 7% mortgage rate is not expensive in terms of where mortgage interest rates have been historically. So,
Mhm,
we may be even on the low end of the average interest rate, and
mhm,
there's a lot of people watching this that are gonna contradict me and say, like, that actually 7% is high,
mhm,
and, it's high compared to the 2.875% that a fair amount of people have.
mhm,
Yes, I agree with that. Uh, but if we go up a generation for when our parents were buying their house, they'll remind you of the 14, 15, 16, 17, eighteen
mhm,
percent interest mortgage interest rates. So
right.
those were out there because that was a different time. Um, but also, if we look at the two, threes, and fours, those rates don't occur naturally in the wild. They're
Mhm,
not mortgage rates that show up on a chart ever, unless the government has decided that they need to lower the rates for the overall benefit of society. And
mhm,
that was called quantitative easing. So
right.
quantitative easing was an artificial period in time where they cornered the market with printed money to buy the bonds to depress the interest rate. They did
Mhm,
it. It fueled a frenzy-like buying atmosphere where everybody went out and
mhm,
bought handsomely, and because the money was really cheap, and those people are parked in good rates, and they're not turning their inventory back into the marketplace to, uh, anytime soon voluntarily, right?
yeah,
They're
yeah,
we're,
yeah.
uh, it's,
Yeah,
yeah,
and when quantitative easing started, correct me if I'm wrong, but rates were north of 7, correct?
right.
Right? So the government intervened at a rate that is higher than we're at right now, drove them, down into what ended up being the 2.5, right, on the low end.
Mhm, mhm.
And now we're back here at 7 where it feels like rates are very comfortable kinda hanging around for an extended
Sure.
period of time. Yeah,
Yeah, yeah.
yeah.
Um, and, if we look at, um, the unique circumstances related to the 10-year treasury bond, um, I've heard it described as that there's a cliff of prior bonds renewing coming off the conveyor belt that were issued at lower interest rates, and that debt being rewritten now at higher rates.
Mhm,
And the the United States appetite to fund fund the whole thing based on debt. So there's a huge issuance of debt occurring in 2025, the
Mhm.
biggest we've ever seen in our lifetime. So
Mhm.
we're a debt hungry country.
Mhm.
We need debt to survive, literally to fund entitlements and operations. And that debt is issued through the sale of bonds. So there's a fair amount of bond sales coming. And I don't necessarily see people overpaying for the bonds because there's an abundance of them, right?
Right.
So the bonds will probably be going off at the auction for, somewhat less and reduced. And we don't have a sovereign bond anymore. It's got a couple of scratches and dents on it, as we saw recently, right? Right. So that,
So I guess I would say, again, we're not trying to predict where the 10-year treasury rates and therefore interest rates on mortgages, we're not trying to predict where that is headed in the future. But the point is, if you've had this moment where you feel like you're ready and you found the place where you want to be for the right reasons, there's no real reason in delaying over some minor changes in rate or a few extra $1,000 here or there, right?
I
It's
it's
yeah.
really pretty small. I guess my point to that last segment was the 2s, 3s, and the 4s, they're not coming back. They're artificially subsidized, and if you're waiting for those, you're waiting for the wrong reason. Really, what you're waiting for is more quantitative easing, which means we get bigger problems.
We've got bigger problems, right.
It
So I'm
right.
envisioning somebody who's doing the math on a property that they really wanna own, and it could be for all the right reasons, but it's just not affordable because the rate is 7%, right? And payment is a function of, the amount you borrow, the interest rate, and the term. So, would you say to folks that are doing the math based on 3% interest rates at some point in the future, it might be time to look in a different neighborhood?
Yes, right, and so if you're hanging on the return of those subsidized rates, you're really hanging on for another reason. You
Yeah,
really are, right? And
yeah,
and so let's just say that that was a historical anomaly. Hopefully, it never comes back because that means we've got a more healthy economy. So no quantitative easing. And so let's dig in on 7% being the functional rate, right? That's
right.
what we have to deal with. And if you can't afford your property at the 7% rate, um, okay, you're not going to get a mortgage, right? So you
Mhm.
have to qualify for mortgage. So you're out.
Yeah,
And if you really want to own, then we have to look at what are the variables that are in your control versus trying to force a variable into from a market that you can't ask for. Like
right,
it's we
right.
can't ask for housing prices to come down. We can't ask for mortgage rates to get lowered.
Mhm.
There's a little bit of hopium that the Fed Reserve may like lower rates. But again, that doesn't affect the mortgage rates.
Right.
But that's what people are hanging on to.
Yeah, yeah. Can we talk about affordability? I mean, for people that aren't familiar, I've always said that what the bank will say you can afford is probably a little bit more than you wanna pay. But just real quick, do you wanna review affordability from the bank's perspective, and talk a little bit about debt to income from a high level? What people are up against there?
Right. So there's the good and the bad on a mortgage. The bad part we talked about it's unforgiving, it's relentless, it's decades, right?
Mhm,
The good part about it is you lock it in yesterday's dollars. So if you lock your rate yesterday, you get your mortgage yesterday. There's a contract that says that payment will never change.
mhm,
So it's sealed in a block of ice, and the contract says it'll never change. So if you flash forward in the future and things are more expensive due to inflation or what have you, but your mortgage is exempt from inflation,
mhm.
if that makes sense. I don't know if
Yeah,
I
absolutely.
did
Yeah,
a, did a good analogy on that. But
yeah,
so so related to affordability, there's some faith that you're locking in and you're sealing that expense, and you can't seal up your rent expense,
mhm,
um, right? That's subject to inflation, but the mortgage isn't. So making a little bit of a stretch in terms of qualification or the reach that our parents and grandparents made, the sacrifices they made to make the mortgage work, it gets easier over time due to inflation.
Mhm.
The other aspects of home ownership will go up, like the hourly rate of a contractor goes up, and the taxes and the insurance will go up over time. But the
Yeah.
bulk of the mortgage payment is trapped in that ice.
I've actually lived that as well. I went back and tried I couldn't find the exact apartment, but I found the building that we were living in, which I thought was expensive at the time. The mortgage on our first home was more, right? And it was a bit of a stretch, and it was really scary because I had to figure out where is that extra, where are those extra dollars going to come from? But that payment hasn't changed. In fact, it's gone down because we were able to refinance over the last few years as rates have come down. Um, and the rent that we were paying is 75% more
Mhm.
over a 7, 8 year period of time. And our mortgage has stayed fixed. So it feels today a whole heck of a lot better than it did when we were staring at the numbers originally, trying to make a decision about whether or not we were going to pull the trigger. So I just wanted to share that. I've lived that as well. It does get easier, and as everything else gets more expensive, it starts to look better and better. Or look a lot more
Yeah,
wise. Yeah.
right. So the pros and the cons of a mortgage contract, right?
Mhm.
Unrelenting, it's due, it's payable, and but it also it's exempt from inflation.
Mhm.
So the good and bad. And so in terms of qualification, uh, making the reach isn't forever, right? Because inflation is going to take everything else up around it.
Mhm.
Hopefully, the value of the house over time, right? It may
Mhm.
have some ups and downs, but during your 10, 20, 30-year journey, you'd expect some inflation on the house,
Mhm.
right? Especially given decades as opposed to just a few years, right?
Right.
Uh, uh, the mortgage payment, as it relates to your future income is gonna seem quite affordable.
Mhm.
The mortgage payment, as a function of the cost of an SUV or whatever else is going on in the world, it's gonna seem like it's relatively, less expensive in the future. That doesn't
Right.
help you today, right? As
But
you
it might make it a little easier to jump on the train, right? To use the analogy, the train's leaving and it's headed in one direction. And there's probably not a better time to jump on than today if you're ready, right? It all
right,
kind of goes back to that idea that you got to start somewhere. You got to get on the train.
yeah, yeah.
Yeah.
And the affordability, uh, issue, sometimes it's self-inflicted, uh, and sometimes it's just a function of the math, what the salaries are bringing in. And the variable piece is the down payment.
Hmm.
So no matter what your salary is, you qualify for something. There's a mortgage that you qualify. There'll be a cap,
Hmm.
and the difference between your cap and the purchase price is the equity that you bring to the table.
Hmm.
Um, so we'll take a look at. Um, so there's certain times in your life where uh, a person may need financial help, and asking family members or parents or grandparents uh, if a gift is available for the purpose of buying a house.
Hmm.
And typically, if you don't ask and the grandparent or parent later found out that you didn't do something because you didn't ask for the gift, they may say, "Why didn't you ask me?" Now,
Hmm.
not every family has that available, but in some cases there are. So I encourage folks to say, "Okay, it's a wholesome exercise. You're trying to um, kind of fortify a platform to to launch from or be stable in a neighborhood, maybe um, raise your kids or whatever it is. It's okay to ask for the gift at that point. It's not like
Hmm.
you're asking every week and you're not buying a sports car. You're
Right.
right. And so you'd be surprised how often that um, a parent or grandparent may be able to provide a gift, which also becomes a gift for them to help.
Hmm.
right? So asking for it, um, it's I don't think it's a mistake if you're asking for the right reasons and wholesome if it's available,
Right.
even if it's a long shot.
Right.
That may help bridge the difference between the purchase price
Mhm.
and there, and then there, yeah, you can try to move some pieces around to make that equity component work, right?
Right.
To get the mortgage payment where
Yeah.
you're comfortable with it.
What are your thoughts on, not to switch gears, but what are your
Mhm.
thoughts on thinking about, say it's your first primary residence, right? You're going from renting to owning your first home, and that's where you're gonna bring your family and raise your kids. How do you have any thoughts about also thinking about that as an investment? And what are your thoughts along those lines?
I think it would be a mistake not to look at it as an investment,
Mm,
right? So yes, it's a house. It's your four walls. It's your safety, your security, where you sleep, where all your activities happen. But if you don't look at the investment side of it, um, then you're making a mistake. So
yeah.
some properties have the ability to appreciate better than other properties just based on where they're located or their attributes. Um, so and it most likely isn't your forever home too. You may be in it for 10 years and then graduate to another state or whatever the case may be.
Right.
So if you're not looking at it as an investment, you're just looking at it as housing, uh, you're ignoring some potential benefit, or you're turning a blind eye on some of the potential risk.
Mhm.
Right. So a home is an investment by definition because it has equity, and at some point you'll harvest that equity, even
Right.
if let's say you're a state that harvests the equity. There is equity there
Right.
that deserves to come back to whoever put it in.
Yeah.
You're kind of expecting it. So
There was
um,
an interesting stat that you had sent over, or was in one of the articles that I read, that said that homeowners are 4,300% more wealthier than their non-homeowning counterparts.
yeah.
So
So
those that, yeah.
it's an amazing stat, and really, like, what does it speak to? How does that disparagement get there, right?
Mhm.
Is there more to that story? And, I, uh that statistic is, commonly published through Kiplinger, and so there's probably 10,000 links back to that, how they derived it. Um, and so one of the things is your part of your mortgage payment, the majority of your mortgage payment is gonna be interest,
Mhm.
but there's a component of it that is principal repayment,
Mhm.
and as a mortgage progresses in the amortization schedule, that principal component increases every month because
Mhm.
the interest is accrued on a slightly smaller balance next month because you paid it down.
Mhm.
So if you looked at it like in a graph format, it's heavy interest, and then there's an inversion point where your payment becomes more principal than interest. And then in the sunset part of the mortgage, it's raw principal and virtually no interest left. You're just repaying yourself. And so
Mhm.
really it's like a 0%, like cost to own a mortgage in that like end 5 years of the timeline. Um, so you're you're contributing a small piece initially to your equity position, but you're also exempt from the inflation and that you have an asset that grows over time. So I
Mhm.
think the 4,300% takes a look at the equity component of homeowners. That they were able to save their 1%, 3%, 5% down payment. They got in. So that's
Mhm.
part of their net worth, right?
Right.
And it may not be a 4,300% differential in liquid net worth,
Right.
but they're sitting on an asset that's appreciating over time. And if
Well, and
you,
that exact point is kind of where my head was at. This idea that, um, even if it is scary, and even if the mortgage payment is more than your rent, right? You are investing in this asset that can appreciate over time. And I meet people all the time as a financial planner that their biggest asset is their home. That is a fairly regular occurrence. Even in my own situation, we chose to be in a pretty high real estate price tag environment because we wanted to be in a certain community close to schools and check all the boxes that we were looking for. And I think about it a lot where I wish I had a little bit more liquid here or there. And
Mhm.
I would if I lived in a different place. But even myself as a financial planner, I'll exclude the equity that we're building in our home as part of my own thought process on it, right? I would have more cash if I didn't live in the house that I live in right now. We could have bought something else somewhere else that didn't check all the boxes. And sometimes I'll beat myself up about that. But then I'll realize I am making an investment in this property and kind of pull that back into the equation. And it makes me feel a lot better that we're doing the right things and we're headed to the right place over time, you know?
Yeah. Yep. Um, right. The home, it'll get a 0 on its value at some point in the future, right? So it'll
Mhm.
be the homes that are bought for $1,000,000 will be worth 10,000,000 in the future. It's inflation, right?
Right.
And so if you're in the journey long enough to see that 0,
Mhm.
um, which will show up, you probably have your mortgage paid off by then,
Mhm.
and that's a full equity position.
Mhm.
Um, uh, that's where, real estate becomes a good augmentation to building net worth.
Right.
Right?
Right.
Um,
Yeah.
yeah,
Yeah.
and it's also it's a leveraged investment, right? So if you were fairly confident that certain investments were gonna go up given enough time and you were able to buy into them, you'd just be buying 1 for $1. But if you could
Right.
get a loan to buy into the investment, you could leverage it, right? And
Right.
so with real estate, 4/5 of the acquisition is other people's money.
Right.
Right? 80%, let's say financed, 20% down payment, or
Yeah.
even 19/20ths, like if you put 5% down, 19/20ths is the other people's money, the bank's money,
Right.
right? But you're
Right.
getting the full asset, which is gonna appreciate. Now,
Yeah.
of course, you're gonna pay interest on that, but, it is there's not too many investments where you can leverage, that kind of power, and real
Yeah.
estate's one of them.
Yeah. Yeah. Again, it all comes back to getting on the train at the right time for the right reasons, right?
Right
Yeah.
time for the right reasons. That like, just freeze that. That's really it. You need the right reasons to get on the train, and when your personal light goes green,
Mhm.
uh, you probably wanna, like, kick down doors to make it happen,
Yeah,
right? Yeah.
and that's I hope that's the main takeaway for people that are faced with what might feel like a scary endeavor to go from renting to home ownership or even moving with rates having gone up. But if it's for the right reasons at the right time, and you've done the due diligence and it is affordable, right?
Mhm.
I have to say that you wouldn't have more liquid net worth if you didn't take on a bigger mortgage payment, right?
Yep.
But if you've done that due diligence and it's for the right reasons, you should still get on the train. It's nothing to be scared of, right? And it's gonna head in the right direction.
It's gonna head in the right direction. Um, well said. Yeah, that sums it up, and I guess related to the affordability, there's gonna be personal household sacrifices that need to occur to make the affordability happen. And that period of austerity or savings or frugality, it's not easy and it's painful. And
Mhm,
the upper generation reminds me of that often, right? What
mhm,
we had to do to make this happen.
mhm,
And so hopefully, to get into the property, folks are willing to make those sacrifices to
mhm,
make the whole project work, right? You
mhm,
can't have the real estate and also have, 5 nights a week eating out, right? So something's gotta give. Um, right.
yeah. Anything else, John? Anything else coming to mind? I think if we've done nothing else, but just to encourage people to continue the journey, and find the path to home ownership and not to be as scared. Not to say that we can ever completely eliminate some of the anxiety around a real estate transaction, But anything else coming to mind that you wanted to share with folks before we cut you loose?
Sure. I had a mentor that explained to me that there's always three clocks running in somebody's life, and so you have a market clock related to what you're working in, and so for me that may be the price of homes or interest rates is that clock, and then there's a career clock, like where you are in your earnings potential. And you
Hmm.
you also have a personal clock, and none of the clocks are the same for any one person. So your personal clock in terms of somebody banging the broom handle on the floor, that rings differently than
Hmm.
somebody else's clock where their lease is coming up for renewal.
Hmm.
So being aware that you have a personal clock and that you can't control like the market or the career clocks, those are just going on. And then look to sync those up and honor the personal clock. Like
Hmm.
don't ignore it. Don't wait for the industry or your work clock to coincide with getting a raise, to coincide with low interest rates, and
Hmm.
then to coincide with what's going on at your apartment. They're never going to line up, right?
Right.
And so just
It's
to be
never going to
aware.
be perfect.
Right. So when people speak of timing, there's three layers to the timing.
Right.
Right, or more, right? And
Right.
and 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 let's look at the personal clock, most importantly, in first, I'd say honor the personal clock, and the other clocks, we just have to kind of accept where they're at,
Yeah. Yeah.
if
It's
that makes
great.
sense. Yeah.
Yeah, absolutely. Yeah, it's never going to be perfect, but the personal probably is the most important. And if that's timing's right, then do your best to kind of figure it out. Go from
Right.
there.
Yeah.
Yeah. John, I always appreciate your expertise. We could nerd out about rates and 10-year treasuries.
Yeah, 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 yeah,
Yeah, and
yeah.
I'll pick your brain offline to spare people the
I know.
technicalities and some of
Yeah.
that. But yeah, I always appreciate you coming on and sharing your expertise and your insights, what's going on. It's always extremely helpful. Where should people go to check out you and Gold Coast?
Yeah, if the, topic is appealing, we have more content written on the tenancy to homeownership journey than any company on the planet at this point. So we have a webpage that's called the Tenants Lounge, and so the tenants can soak up all their information there about the homeownership journey. So goldcoastmortgage.com/tenants lounge,
Cool.
and that's where they can find all the geeky information related to. Yeah.
Awesome. Yeah,
Thank
I
you.
encourage people to get into the weeds. It's a great resource. Thanks again, John. Look forward to talking to you soon. Thanks everybody for listening or watching the video. We appreciate it. And if you like what you saw, feel free to head over to modernfinancialwellness.com, sign up for the newsletter, and we'll see you next time. Thanks
Okay.
again.
Thanks, Jim.
Thanks again for listening to this episode. A quick note, although I do hope that the information that we talked about was helpful, in no way is anything discussed on the podcast to be taken as specific financial advice. Please consult your own advisors and do your own research when you're making important financial decisions.